If you think the number in your bank app is your money, you have already misunderstood the game. What you see is a picture. What the system sees is inventory. That is the difference between a person who feels safe and a person who actually is safe. One is staring at a screen, the other understands where the bars are. Most people do not lose their financial freedom in one dramatic collapse. They lose it quietly, politely, and with perfect monthly statements. They lose it because they mistake convenience for control. They leave their savings in institutions that pay them almost nothing, lend their money to someone else, charge fees at every layer, and then hand them a login screen as if that were sovereignty. It is not sovereignty. It is a cage with a polished door. I have spent my life watching capital move, watching incentives expose people, watching institutions tell the public one thing while doing another with their own balance sheets. When the smartest money starts moving in one direction while the ordinary saver is still staring at a savings account and a brokerage dashboard. I pay attention, you should, too. And right now the message is not subtle. While most people are watching the stock market wobble, oil spike, and the Federal Reserve freeze in place, the real move is happening somewhere quieter. Large pools of capital are pushing money away from the most crowded parts of the traditional banking and brokerage system and into structures with fewer hands on the asset. Fewer promises standing between owner and value, and less dependence on the emotional weather of the market. That is not paranoia, that is capital allocation under pressure. I want you to understand something that should make you uncomfortable. Your salary can be high and your strategy can still be low. Your account balance can be large and your control can still be small. Your portfolio can look diversified and still be built inside one cage. That cage has 3 bars. The first bar is the lending bar. If your money sits in a traditional bank savings account, that money is not resting. It is being used. Your deposit is, in economic substance, a loan to the bank. You become a quiet creditor while the institution captures the spread. You accept tiny yield, they take the operating advantage, and you tell yourself you are being conservative. A lot of people call that prudence. I call it rented confidence. The second bar is the market bar. When your wealth lives inside a brokerage account full of ordinary paper claims, it becomes exposed to forced selling, margin calls, algorithmic liquidation, panic pricing, and every headline that turns nervous people into impulsive people. You think you own a future stream of value. The system treats your position like inventory that can be marked down in real time. The third bar is the inflation bar. This one is the most dangerous because it rarely feels like danger. It feels like patience. It feels like normalcy. It feels like doing nothing. And while you are doing nothing, purchasing power leaks out of your life the same way air leaks out of a tire. Slowly enough that the untrained eye misses it, fast enough that a decade later you wonder why the same number buys so much less. That is the cage, a polished interface, a monthly statement, a little interest, a little hope, a lot of surrender. The system does not need to steal from you openly. It only needs to convince you that passive erosion is safety. Look at the arithmetic that should slap you awake. The average bank savings rate in the source material sits around 0.39%. The I-bond rate discussed there is 4.03%. Inflation expectations in the same document are running well above what ordinary deposit yields can absorb. And the text makes the simple point that if inflation is around 3% while your bank pays 0.39%, your real purchasing power is shrinking every year. That is not a technical footnote. That is a silent tax on people who still confuse stillness with protection. When a person keeps $100,000 in an account like that, the statement can show a stable number while the life behind that number gets weaker. Groceries do not care about your login screen. Insurance does not care about your comfort. Energy does not care that your bank app uses soothing colors. Real life invoices your purchasing power in full. And the timing matters. The source document is built around a very specific pressure environment war risk. Oil shock reaccelerating inflation pressure, a Federal Reserve expected to hold instead of rescue, a savings system paying ordinary people almost nothing, while institutions quietly reposition. That environment is not what creates the cage. It simply makes the bars visible. This is where most people make the first big mistake. They think danger begins when something collapses. Danger begins when incentives stop serving you, and you do not notice. A man with debt, rising living costs, no refusal power, and all of his reserves sitting inside low-yield, high-dependence structures is not safe, because nothing has broken yet. He is simply standing in a room whose door can lock faster than he expects. That is why I want to rename this whole problem for you. Call it the dependence cage. The dependence cage is what happens when every dollar you own needs somebody else to behave well. In order for your strategy to work, your bank must stay sound, your broker must stay functional, the market must stay liquid, rates must move in your favor, inflation must behave, tax rules must stay kind, your emotions must stay calm, and all of that has to happen at the same time for you to feel secure. That is not a fortress. That is a chain of promises. I do not build my life around chains of promises when I can own a piece of economic reality more directly. That is the underlying judgment in the document you gave me, and it is the most valuable thing in it. Not the promotional shell, not the video pacing, not the call to action. The core judgment is simpler and stronger under pressure. Serious capital tends to reduce counterparty dependence, reduce middlemen, and move toward assets or structures that are harder to dilute, harder to freeze, harder to lever against the owner, and easier to understand in plain English. That is the real story. Now let me push the knife a little deeper, because if you do not feel slightly exposed, you are not hearing me correctly. A lot of people say they want freedom, but what they really want is reassurance. Freedom demands structure. Reassurance demands a screen. Freedom asks, who controls the asset? Reassurance asks, does the app look stable? Freedom asks, what happens if rates stay higher, inflation stays sticky, and institutions stop offering easy exits? Reassurance asks, can I avoid thinking about this until next quarter? That is why the ordinary saver stays trapped longer than the ordinary spender. At least the spender knows he is making consumption choices. The trapped saver often thinks he is being disciplined while accepting a negative real return, fee drag, and system dependence all at once. The source material points to something very important that most people miss because it sounds almost too boring to matter. The people who profit from your money being left inside the old rails rarely have any incentive to educate you about the new rails. A bank does not want you bypassing its balance sheet. An advisor does not cheer when the solution carries no commission. A financial media ecosystem does not get excited about a government website that charges no annual management fee and makes no one rich from distribution. That is not a conspiracy. That is incentive math. Once you see incentives clearly, the cage stops looking like safety and starts looking like a business model. Now we get to the part that matters, not fear. Structure. The document presents 3 legal routes for moving portions of wealth outside the usual bank and brokerage dependence. I am not going to repeat them the way a listicle would. I am going to show you what each one really does to the cage. The first route weakens the counterparty bar. The second route weakens the middleman bar. The third route weakens the tax bar while reinforcing the first 2. Start with physical precious metals, especially gold and silver held as physical assets rather than paper substitutes. The source makes the direct point that physical gold carries zero counterparty risk in the sense that no institution has to keep a promise for the asset to exist as your asset. A stock is a claim, a bond is a promise, a deposit is a loan. Physical metal is the thing itself. That distinction matters far more under stress than it does during a calm year when everybody feels clever. That does not mean you worship gold. It means you understand function. I want you to call this layer no permission wealth. No permission wealth is any portion of your reserves that does not need a manager, a banker, a fund gate, an algorithm, or a cheerful television personality to validate its existence. It simply sits there outside the emotional theater of the day. If you own a physical coin or bar properly and directly, no one has to send you an email saying you are allowed to own it. No one has to reopen the market. No one has to avoid a margin call for the asset to remain what it is. The source emphasizes that central banks have been buying physical gold at extraordinary rates and that the dollar share of global reserves has been falling, while gold's share has been rising. Whether you focus on the exact figures or simply on the directional behavior, the logic is clear. The institutions closest to the plumbing of the monetary system have been reducing blind faith in paper claims and increasing exposure to the oldest reserve asset in the world. That should not make you superstitious. It should make you observant. Notice how different that is from the way ordinary people talk about money. Ordinary people ask, what is hot? Serious capital ask, what survives stress? Ordinary people chase story. Serious capital studies structure. Ordinary people want upside without discomfort. Serious capital first asks what cannot be allowed to fail. That is the psychological shift. You do not buy a layer of direct physical reserve because you are trying to look exciting. You do it because dependence is expensive. You do it because there is a difference between wealth that can be delayed and wealth that can be denied. The source also makes an important limiting point, and I want to preserve it because it keeps the whole argument honest. Physical metal is not a checking account. It is not instant click, toe, sell liquidity. Converting it may take time. That is why the right mental model is not all or nothing. It is layered defense. Not every dollar needs the same job. Some dollars need immediate mobility. Some need inflation resistance. Some need deep reserve status. People get in trouble when they force one bucket to do every job badly. That leads to the second route. And this one is one of the most useful boring advantages in modern finance. Buying government securities directly through Treasury direct strips out the middleman. I want you to call this direct rail capital. Direct rail capital means you stop paying for the illusion that access must always come wrapped in an institution. If the government will let you buy certain securities directly from the source, then at least a portion of your capital can ride a cleaner rail. The document highlights I-bonds at 4.03%, a fixed rate plus inflation component, a principal value that cannot go below purchase price, annual purchase limits, a 1-year lock, a small early redemption penalty before 5 years, and the broader menu of treasury bills, notes, tips, and floating rate notes available through the same system. More important than the menu is the structure. Held directly, no bank balance sheet in between, no advisor commission, no annual management fee. That is not glamorous. It is better than glamorous. It is clean. Most people do not appreciate how much of their life gets chewed up by the middleman tax. I am not talking only about explicit fees. I am talking about complexity tax, ignorance tax, sales tax, disguidance, and dependency tax disguised as convenience. Every time a person believes he must hand his financial judgment to a chain of intermediaries just to capture a plain vanilla government backed yield, he has already surrendered too much strategic ground. The source uses very plain arithmetic to make the point. A large difference in yield on cash and cash, like reserves, compounds into real differences in annual income, even before you discuss the inflation adjustment. That is not trivia for retirees. That is lifestyle math. That is medicine and rent and utilities and sleep. And the principal guarantee matters psychologically. People love to say they are long-term until the market takes a chunk out of something they thought was safe. Then their time horizon shrinks to about 8 minutes. That is why structure must match human behavior. If you know a portion of your reserves cannot be marked down below purchase price in nominal terms, you have changed not only the return profile of that money, but also the emotional profile of the household. You have reduced panic bandwidth. You have created breathing room. Breathing room is underrated because it does not show up as bravado. It shows up as better decisions. That is what most families actually need. Not more financial entertainment, more decision quality. Now, the third route in your document is where the architecture gets more interesting because it combines direct reserve logic with tax logic, a self-directed precious metals IRA, especially with Roth treatment in the structure described, is what I would call a tax-free vault. The source explains the mechanics. Certain retirement assets can be rolled or transferred through proper channels into a self-directed IRA that can hold IRS-approved physical precious metals through specialized custodians and approved depositories. If structured as a direct trustee to trustee transfer, the rollover itself is not a taxable event. If one converts into a Roth framework, growth from there can be tax-free, which changes the after-tax mathematics of appreciation dramatically. The document even walks through a simple illustration of moving $200,000, converting holding physical gold inside the structure, and then comparing the value if gold moves higher. Whether one chooses that exact path is a personal decision. What matters conceptually is what this does to the cage. It takes a reserve asset, stores it outside ordinary bank and brokerage exposure, and lets the growth occur inside a more favorable tax box. That is not a toy. That is architecture. And architecture beats emotion. A lot of people have spent years treating retirement accounts like giant vending machines for whatever Wall Street happens to be marketing that season. They call it diversification because the labels are different. But if the underlying exposure still depends on the same broad system behavior, the labels do not save you. You can own 12 things and still have one cage, a tax. Free Vault changes the job description of that retirement money. Instead of saying, this account exists to maximize excitement and benchmark comparison, you say, this account exists to preserve strategic purchasing power, reduce dependence on paper promises, and shelter appreciation inside a structure the tax code already allows. That is a different operating system. I want you to hear the deeper point. The richest families and the strongest institutions do not merely pick assets. They pick legal containers, they pick tax treatment, they pick custody arrangements, they pick which part of their life must remain liquid, which part must remain insulated, and which part can take risk without threatening the household. In other words, they do not just buy things, they design rails. Ordinary people keep looking for a magic ticker. Serious people keep improving architecture. That is why this transcript, stripped of its sales shell, contains something valuable. It is not really a story about gold. It is a story about financial architecture under stress. Now let me connect this back to the macro pressure, because that is where the emotional urgency comes from. The source builds its case around a world in which oil pressure can feed inflation, the Federal Reserve can remain constrained, real rates can stay painful for ordinary savers, and labor market softness can sit beside sticky prices. That is a miserable mix for households who depend entirely on wages and low-yield deposits. Wages are linear. Living costs are not always linear. Asset prices are volatile. Fees are persistent. Inflation is quiet until it becomes intimate. It shows up first in inconvenience, then in choices, then in dignity. This is where the worker versus owner contrast becomes brutal. A worker without reserve architecture sells time into a world where costs can reprice faster than wages. An owner with reserve architecture can let a portion of capital work in systems designed to resist exactly that squeeze. A worker trapped in the dependence cage is always one surprise away from becoming obedient. An owner with direct reserves develops what I call refusal power. Refusal power is one of the most valuable forms of wealth because it changes your behavior before it changes your income. It is the ability to say no to panic selling, no to bad debt, no to humiliating dependence, no to a terrible job offer, no to an institution that pays you almost nothing while profiting from your inertia. You do not build refusal power with motivational slogans, you build it with structure. That is why ordinary personal finance advice so often misses the point. It tells you to be patient, budget better, maybe buy broad index exposure, maybe keep an emergency fund, maybe avoid lifestyle inflation. Some of that is fine as far as it goes. But it often lacks an adversarial understanding of the system. It speaks as if you are living inside a neutral machine. You are not. You are living inside a machine full of incentives. The machine is not evil. It is simply hungry. And if you do not design your own rails, you will live on someone else's rails for the rest of your life. Now, let me make this concrete the way a good allocator should. The source provides an example of a 62-year-old retiree with $300,000 spread across savings and retirement accounts. I do not care whether the exact age or amount matches your life. What matters is the pattern. A slice remains highly liquid and earns something real instead of symbolic dust. A slice goes into inflation-protected government, backed instruments through direct purchase. A large strategic slice shifts into a tax, advantaged precious metals structure. A remaining slice can still stay in market exposure for growth, because leaving the cage does not mean abandoning all risk. It means deciding which risks you accept and which dependencies you reduce. The beauty of the example is not that it is flashy, it is that no single point of failure can destroy the whole picture. That is what adults should want from money, not constant stimulation, fewer catastrophic points of failure. Read that again as a philosophy, not as a set of instructions. You do not need every dollar in the same theater. You do not need every dollar chasing the same promise. You do not need every dollar to be liquid, speculative, yield, starved, and emotionally fragile at the same time. Once you understand that, the cage starts to crack. And there is another thing I want to expose because it keeps millions of people passive. It is what I call the balance illusion. The balance illusion is the false comfort you get from seeing a familiar number in a familiar institution while ignoring what that number can actually do for your life. It tells you that if the nominal figure did not fall, you are fine. It tells you that access equals control. It tells you that a low yield deposit is conservative even when it is mathematically losing purchasing power. It tells you that a retirement account full of paper claims is diversified even when it is built on one layer of systemic trust. It tells you that because the cage looks normal, it must be safe. That is how people drift through 10-year periods and discover they were never defending wealth at all. They were defending appearances. I have no interest in appearances. I care about purchasing power. I care about optionality. I care about dignity. I care about the ability to think clearly under pressure. I care about what still works if rates do not rescue you. If inflation stays annoying, if a bank pays you an insultingly low yield, if a broker makes access feel easy while making ownership more abstract, and if the next market scare arrives before your emotions are ready. The source also talks about gold not as a speculative frenzy, but as a comparatively lower volatility alternative to fiat exposure alongside continued ETF inflows and strong institutional demand. Again, the exact marketing tone in the transcript is less important than the behavioral signal. People closest to monetary fragility are not positioning as if paper confidence will solve every future problem. They are building reserve layers. You should ask yourself a question that is far more important than whether gold reaches one forecast or another. If the people closest to the system are reducing dependence on the system, why are you increasing yours? If the answer is convenience, then convenience has become your jailer. If the answer is habit, habit has become your financial advisor. If the answer is that no one told you, now that excuse is gone. I am not telling you to become theatrical. I am telling you to become deliberate. There is a difference between fear and structure. Fear is emotional. Structure is chosen. Fear buys randomly. Structure layers intentionally. Fear wants to escape discomfort. Structure wants to survive reality. That is why the final lesson here is not buy this and everything will be fine. Anyone who speaks that way is selling a narcotic. The real lesson is harsher and better. Your money needs job descriptions. Your money needs custody decisions. Your money needs tax decisions. Your money needs liquidity tiers. Your money needs a relationship to inflation, a relationship to counterparty risk, and a relationship to your own psychology. If you refuse to make those decisions, the cage makes them for you. And the cage is always optimized for the institution, not for the person inside it. This is also where reputation and self-respect enter the conversation, because people think those words belong only in moral philosophy. They do not. A person who keeps his family financially exposed to obvious structural weakness because he wanted the comfort of doing what everyone else does is paying an invisible reputation cost to himself. He becomes less decisive, less calm, more dependent. He may still look successful from the outside inside. He knows his strategy is softer than his lifestyle. I do not like that softness. You should not like it either. The world does not hand out medals for looking well organized while your reserves are slowly being diluted. The world rewards people who know the difference between signal and decoration. Signal is direct ownership. Signal is net purchasing power. Signal is tax. Our architecture, signal is reserve layering. Signal is the ability to withstand a bad sequence of events without becoming desperate. Decoration is app design. Decoration is financial jargon. Decoration is a statement that looks stable while real life gets more expensive. Decoration is pretending that broad exposure alone is a complete strategy. I want to give you one more framework you can carry with you. Call it the freedom ladder. The bottom rung is trapped cash, money earning almost nothing, fully dependent on institutions that profit from your passivity. The next rung is direct reserve cash. Money placed where the yield is cleaner, the rail is shorter, and inflation protection is built into the structure. The next rung is no permission reserve. Assets held more directly, harder to dilute, harder to freeze, less tied to daily market theater. Above that is tax-sheltered reserve architecture, where the legal container matters as much as the asset, and above that is refusal power, the point where your financial structure changes your psychology because you know you do not have to react like everyone else. That ladder matters because most people are trying to leap to wealth while standing on a weak first rung. They want upside before structure. They want status before insulation. They want a bigger cage. That is not my game. My game has always been to understand incentives, buy with reason, and stay positioned so that time is my ally instead of my enemy. For ordinary people, that principle does not begin with picking a famous stock. It begins with deciding that your life savings will no longer sit passively where inflation, fee extraction, and system dependence can work on them without resistance. The transcript ends by saying the window is open and ask whether you will use the tools. I want to sharpen that into the only form that matters. The question is not whether the tools exist. They do. The question is not whether they are legal. The question is not whether sophisticated capital already understands them. It does. The real question is whether you are willing to admit that the old arrangement was never as safe as it felt. That is the hard part, because once you admit that, you have to choose. You can keep telling yourself that the statement balance is good enough, the yield is close enough, the fees are normal enough, the dependence is harmless enough, and the next shock will probably be manageable enough. That is one path. It is the path of polite erosion. It is the path where you remain useful to the cage because you never challenge the rails. It is the path where 10 years pass and you discover that you had income, discipline, and opportunity, but you did not have structure. Or you can decide that a portion of your life will no longer be rented out to other people as incentives. You can decide that some of your money must become harder to debase, harder to trap, harder to misprice, and harder to tax into mediocrity. You can decide that convenience is not a strategy. You can decide that your reserves deserve architecture. You can decide that freedom is not a slogan, not a mood, not a motivational poster. It is a custody decision. It is a tax decision. It is a liquidity decision. It is a refusal decision. That is the door. Most people will walk up to it, nod politely, and step back into the cage because the cage is familiar. A smaller number will understand that the bars were never made of steel. They were made of habit, ignorance, and outsourced thinking. And once you see that clearly, you are left with a test that no one can take for you. Will you keep protecting the appearance of safety, or will you start building the kind of structure that can still stand when reassurance disappears?